Most beginner investing advice online sounds intelligent, sounds logical, sounds responsible, and still quietly keeps people financially stuck. Because modern finance content is optimized for attention, not for accuracy. Simple ideas spread faster than correct ideas, and confident statements spread faster than nuanced explanations. So what happens? Millions of people follow advice that sounds reasonable, but does not actually help them build long-term wealth. And the most dangerous myths are not the ones that sound stupid, they're the ones that sound intelligent, because intelligent-sounding mistakes are the hardest to detect. Today we break down 7 global investing myths that continue to confuse beginners, slow down progress, and quietly destroy long-term results. No hype, no predictions, no promises, only structure, because wealth is not built on slogans. Wealth is built on decisions repeated for years. Welcome back, or welcome for the first time. This is Grecia Capital, and this channel is about building real wealth the calm, structured way, without hype, noise, or fake certainty. This is week 7 of the Global Wealth Foundation. So far we've talked about what wealth actually is, how investing works, why diversification matters, how markets behave, what different assets actually do, how portfolios are structured. Now we move into a very important layer, misinformation. Because the internet is full of simplified financial ideas, and simplification without context often creates misunderstanding, and misunderstanding creates expensive decisions. Before we begin, if you want practical long-term investing education, explained clearly and step by step, subscribe so you do not miss the next lessons. This series is designed to build knowledge in the correct order, so each episode makes the next one easier to understand. Let's begin. One of the most common reasons people delay investing is not lack of access. It is the belief that the starting amount is too small. Let me ask you something. How much money do you think is required to start learning? Because investing is a skill, and skills develop through repetition, not through waiting. Many people tell themselves, I will start when I earn more. I will start when I save more. I will start when I feel ready. But readiness is usually created by starting, not before starting. Small investments are not about becoming rich immediately. They are about learning how you react to uncertainty, how you react when markets fall, how you react when markets rise, how you react when nothing happens for months. Because the biggest challenge in investing is rarely mathematics, it is behavior. Small amounts reduce emotional pressure, which allows learning. Learning creates confidence. Confidence creates consistency. Consistency allows compounding to work. The real danger is not starting small. The real danger is delaying participation, because time is the only resource investors cannot recover. Dividends are often described online as passive income, and they can feel satisfying. Money appears in the account without selling anything, which creates the impression of extra profit. But dividends are not created from nothing. They are part of the company's value distribution. When a company pays dividends, its price usually adjusts accordingly, because part of the value was transferred. So dividends are not magic money, they are structure. Dividends can be useful, but misunderstanding dividends can lead to poor decisions. Some investors chase dividends without understanding total return. Income is visible, but total return includes growth and income combined. Let me ask you, would you prefer an asset that grows 8% or one that pays 4% dividend but grows 2%? Without context, numbers can mislead. The label dividend feels safe, but function matters more than labels. Always ask, what role does this asset play in the portfolio? Income, growth, stability, tax efficiency, structure first, labels second. Trading content is everywhere. Fast profits, quick decisions, exciting results. screens full of charts. But let's ask a difficult question. If trading was easy, why do professional traders spend years learning risk management? Why do institutions invest millions in research? Why do most trading strategies fail to outperform simple long-term strategies after costs? Trading is a competitive activity with skilled participants, with uncertainty, with psychological pressure. Many beginners confuse activity with progress. More trades do not automatically create better outcomes. More decisions often increase emotional exposure. Short-term outcomes are heavily influenced by randomness, which creates the illusion of skill, especially during positive periods. But skill is measured over long time horizons, consistently, not occasionally. Trading is not impossible, but it is often misrepresented. Investing does not require constant action. It requires consistent structure. Risk and return are related, but not in a simple linear way. Higher risk does not guarantee higher return. Risk creates possibility, not certainty. Some risks are compensated. Some risks are not. Let me give an example. Taking concentration risk does not guarantee higher return. Taking speculative risk does not guarantee higher return. Taking emotional decisions does not guarantee higher return. Risk without understanding is not strategy, it is exposure. Professional investors do not simply increase risk. They try to select risks that historically had positive expected outcomes. Expected return is not a promise, it is probability, and probability only works over time and through repetition. Cash feels safe because numbers do not move. No volatility, no red charts, no stress. But safety has more than one dimension. Nominal stability does not always mean real stability. Inflation slowly changes purchasing power, often quietly, often unnoticed in the short term. Cash has an important role: liquidity, emergency fund, psychological comfort, flexibility, optionality. But long-term wealth is usually influenced by assets that participate in economic growth. Cash protects stability in the short term, but may lose efficiency in the long term. Everything has a function. Confusion begins when function is ignored. Buying at the lowest possible price sounds optimal, but consistently identifying the lowest point is extremely difficult. Even professionals rarely succeed consistently. Many investors wait for perfect entry and remain in waiting mode for years. Markets move before certainty appears. Participation often matters more than precision, because long-term investing is usually built on repeated decisions, not single perfect decisions. Perfect timing is attractive, but consistency is more realistic. Exciting assets attract attention because humans are attracted to stories, innovation, narratives, possibility of extreme outcomes. But investing and entertainment have different objectives. Excitement is not required for functionality. Airplanes are not exciting when they work correctly. Electricity is not exciting when it works correctly. But reliability creates results. Boring assets often provide predictability. Predictability can improve consistency. Consistency improves behavior. Behavior influences outcomes. A portfolio is not designed to entertain. It is designed to function. Most investing myths do not sound extreme. They sound reasonable, which makes them dangerous because partial truths can create incorrect expectations, and incorrect expectations often lead to disappointment, and disappointment often leads to quitting. Long-term investing does not require perfect predictions. It requires clarity of function, clarity of horizon, clarity of structure, clarity of behavior. Before we finish, if this video helped clarify how investing myths influence decisions, consider subscribing. This series is structured step by step, so future episodes will build on what you already understand. And if this topic matters to you, leave a like It helps this series reach the right people. Thanks for spending this time with me. This is Grissia Copenal, calm, structured, long-term investing education. Next week we move into starting frameworks, decision structure, and how beginners can move from theory to practical implementation. Until then, build for reality, build for consistency, and build with structure. I'll see you in the next one.